Just like equities, bonds have been showing some increased volatility as of late. After a run-up in treasuries last week, we saw a sell-off earlier today and now seemingly finding a little bit of a bid. It's been back and forth, a roller coaster ride between price and yield. Joining me now for their assessment of the bond markets are Joanna Gallegos, the co-founder and COO of Bondbloxx, alongside Todd Sohn, technical strategist over at Strategas Securities. Thank you very much, first of all, Todd and Joanna, for being here with us on ETF Edge. Joanna, I'd like to start off with your assessment of the recent volatility that we've been seeing on the Treasury/rates market.
Yeah, so I think the volatility that's been in view and been talked about probably since early April has been on the long end. So even if you just look at the Treasury, the 20-year Treasury year to date, it's gone from negative to positive returns 5 times. So it's really experienced a tremendous amount of volatility that everybody's been watching. One of those turnarounds was over 7.5% within, I think, a week. So if you're looking at the long end of the Treasury market, lots of volatility, lots of concern about what it means for the economy. If you're looking at other segments of the curve and you're looking towards the shorter to the middle end, it's looking more traditional. It's looking less volatility with stable yields. It's been very supportive in portfolios this year. Across the curve, now, as we've gotten through April, returns are up. So, if you had your Treasury exposure, you've gone on a big, big ride since April, but things have calmed down.
What exactly, Joanna, has been driving the volatility, especially on that long end side, compared to the seemingly relatively stable part of the shorter term of the curve?
It's supposed to be volatile in times of uncertainty. It's supposed to reflect the longer term view of where the economy is going. And if you can't see past 3 months through maybe a tariff change, or you're not sure exactly what the playing field is, it will be volatile. It's actually functioning as it's supposed to. It's an important barometer to show where uncertainty is in the market.
Now, risk aversion factor, Todd, is also something that we're paying close attention to. From a technician standpoint, what do you make of the recent kind of activity that we've been seeing, both from a price/yield perspective? And then what have you been watching for and what have you been seeing when it comes to some of the money that's been flowing into or out of certain parts of the ETF market, with specifically targeting the bond side of things?
Yeah, it's a great question. I think the important stat to keep in mind here, and this pairs along with what Joanna just said about volatility, is that we're 9 months into the cutting cycle since the first cut from the Federal Reserve, and both long duration treasuries and long duration corporate bonds are down since September 18th. That's extremely rare. I can only count one other time that's happened, and it was during the financial crisis, for what's that's worth. And so long duration doesn't work. I think it makes much more sense to stay down the curve. And in terms of flows, I think throughout this year and really since the April 8th low, you have seen mass amounts of money go to treasury bill ETFs, and more shorter duration too, so going out 2 to 3 years on the curve. So flows remain very much on that less volatile side. There's been a pinch of money going to long duration, but I think investors have finally acknowledged that it remains a very volatile market that's just not working anymore. So they're comfortable staying in that cash-like vehicles there, and I think that's fine for now until there's much more clarity on the long end, whenever that might occur.
If there is, Todd, lack of clarity, and it's kind of the general construct we've been working in, right? It's very headline driven. It's very White House trade negotiation, Treasury Department, USTR driven flow activity with regard to news. Does that make you feel as though that kind of rates side of things, the Treasury side of things, is range bound until there is a fundamental breakthrough in terms of the economy and or trade talks?
Yeah, I think that's the right call, right? The right call is no call on anything 7 years and above on the yield curve, right? It's just there's just nothing there for us from, if I were to put on my technician hat, it's just a sideways, huge volatile range. And that's just not something I think I want to sit through, or many investors want to sit through now. You can get opportunistic if you'd like, if you feel the economy might be deteriorating. Of course, that's when it makes sense to add some of those longer duration instruments. But for now, you're still getting the similar type of yield and far less volatility down the curve. And I think that's just a hard proposition to want to argue against going forward.
Todd, one more question to you. If you, from a strategy standpoint, you have your technician hat, your strategist hat on, If I asked you what your favorite part of the market was, no matter what the asset class is, what is it right now?
Listen, it's hard to argue against short duration fixed income, but how about international equities? I mean, I know we haven't talked about that at all here. This has been more the focus on the bond side of the equation, but international equities are contributing to portfolios again in a way that they have not done in over a decade. Last year it was Japanese equities working, and this year it's European equities working. So to the extent that in the 40 part of the equation you're getting income again, in the 60 part of the equity equation you're now getting international again too. So this is great for investor portfolios. You don't have to be loaded up on large cap growth anymore as you did during the QE era. That's a meaningful change that I think everyone needs to be aware of.
All right, not just Mag 7. All right, Joanna, you get the last word. If you had one big fear in your world, what exactly would you be on the lookout for? What exactly would give you a moment of pause about how things are developing in this market, structurally, fundamentally, or anything else?
Well, I think my fear is people haven't really re-engaged with how the bond market's working for them. I think that there is a lot of focus on that long-term rate and the volatility, and what people are missing is, my fear is that they're not diversifying their portfolio with bonds today. We really have an equity addiction to concentrated broad-based indexes now that are overweighted certain tech names that really move that indexes quite a bit. People get used to, and they've appreciated these double-digit 20% returns that they've seen in equities. And every time we have a bout of volatility, we forget about, well, when are you going to add that income to your portfolio? When are you going to add more fixed income? Because these markets, these volatile, reactive markets, are the time for fixed income to add more bonds to your portfolio in the ways that we were describing. If you don't do that, you don't take a look now, you'll have that feeling whenever the next bout is, 3 months, a week, I'm not sure. So in this time of uncertainty, you have to accept that the uncertainty is going to continue and the volatility is going to continue. So my biggest fear is that people don't actually take action in their portfolios with more bond exposures that are precise and are really do work for you.
All right, Joanna, Todd, thank you guys very much to be here with us here on ETF Edge. That does it for this week's ETF Edge edition. My thanks again to Joanna Gallegos at Bondbloxx, also Todd Sohn over at Strategas. Now, I've asked Todd to stick around for a few more minutes and provide some insights into the ETF trends that he's seeing for our ETF Edge podcast. That's coming up. And remember, you can always see all of our shows on our website. It's etfedge.cnbc.com. Thank you guys so much, and we'll see you next week on the ETF Edge.